Welcome back to the Wall Street Podcast. Today, we're doing a deep dive into a recent Goldman Sachs research report. It's titled JD Logistics, 2618 to HK, NDR Highlights, Expanding International Business While Investing for Domestic Growth, by. Came out August 17, 2025. This followed their Q2 results and talks they had with the CFO, Mr. Hao Wu.
Exactly. And this report really digs into JD Logistics strategy. It looks at their big push internationally, how they're still investing heavily back home in China, networks, tech. Also covers how they're dealing with competition and optimizing things like delivery rider time. Basically, it gives us a good window into their financial direction and, well, their main operational priorities.
Okay, let's start with that international piece. They seem to be accelerating quite a bit. The report mentions maybe several hundred million RMB in losses for 2025 because of it. That sounds like a change from 2024 when overseas was apparently break even.
It is a shift, yes. Those losses are tied to the upfront investments needed to scale. But the thinking seems to be that the demand internationally is strong and maybe pricing isn't quite as pressured there. The key, they stress, is getting the local execution right.
Any specific examples of that scaling?
Yeah, they mentioned Saudi Arabia specifically. Operations there are apparently scaling well, on track. They're looking for maybe 3 to 4 times the daily orders by the end of this year, 2025. And Europe is also set to start scaling up orders from September 2025. So it's a broad effort.
Okay, so big global plans. But what about domestically? You mentioned continued investment. They're already a major player, right? Top 2 in time-definite express delivery.
Correct. They hold a strong position there. And they're not standing still. They're continuing to invest in the network, intra-city delivery too. That means hiring more full-time riders. Infrastructure like the big sorting centers and trunk lines is mostly built out, though some of the spending, the CapEx, hasn't hit the books yet because of payment timing.
Well, more investment coming online.
Seems so. They're planning around 15% more network staff recruitment. Plus, they're exploring more tech automating trunk lines, maybe unmanned vehicles, and even looking at bringing some logistics currently done by third parties in-house. Oh, and a specific number, around 200-300 million RMB earmarked for warehouse automation this fiscal year, FY25.
That's substantial investment, especially when you consider the domestic competition. The report mentions express average selling prices, the ASPs, are down single digits year over year across the board.
That's a key pressure point, and it's particularly intense for things like reverse e-commerce parcels, returns. There's increasing pricing pressure coming directly from the big e-commerce platforms.
So how are they getting more efficient to cope with that pressure, besides the big infrastructure plays? Anything on the operational side, like with the couriers?
Yes, actually. They're running a pilot program, having their parcel couriers fulfill food delivery orders during off-peak times for parcels. The idea is to optimize the use of that rider capacity across the day, improve overall volume, get smarter about allocating orders, and boost those service metrics like on-time rates for everything.
Interesting. Kind of a dynamic resource allocation. So pulling this together from an investment view, what's the Goldman Sachs take? Still positive.
They're maintaining a buy rating. The 12-month target price is unchanged at HK $17.77. That implies, well, pretty significant upside, about 32.8% from the price on August 15th, which was HK $13.33. But they do flag risks, naturally.
Such as?
Well, a big chunk of revenue still comes from the parent, JD Group, around 30% back in 2023. There's also concentration risk in certain industries. And, being positioned towards the higher end, they could face growth pressure if the broader economy softens.
Okay, let's crystallize some of this for investors listening. First question. What are those immediate financial implications of this big international push?
Right. The immediate hit is the expected loss for 2025, that several hundred million RMB figure. It's a shift from break-even in 24, purely due to spending now for growth later. But the counterpoint is the projected strong volume growth and the expectation that losses will narrow in 2026. That Saudi 3-4x order growth by year end, that's the kind of proof point they're likely highlighting for this strategy. It's about capturing market share.
Second, thinking about that domestic pressure versus investment, how are they actually balancing those two things, investing while ASPs are falling?
It's tough, no doubt. Amidst falling prices and that reverse e-commerce squeeze, they're doubling down on their strength. That means the planned 15% increase in network staff, the big warehouse automation, spend that 200-300 million RMB. They're focusing on improving the quality of their time-definite service, exploring automation. It's about becoming more efficient and differentiating on service to justify their position, even with price pressures.
And third, beyond the big ticket items like warehouses and staff, what other operational tweaks, maybe smaller innovations, are they using to get more efficient?
That courier pilot for food delivery is a prime example. It's about sweating the assets harder, basically, using existing couriers during their downtime for parcels to handle food deliveries. The goal isn't just filling time, it's about optimizing the whole system, better order allocation, smoothing out volume, and hitting those on time targets more consistently for both parcels and food. It signals a move towards smarter, more dynamic resource use.
So for you listening, these aren't just abstract corporate strategies. These shifts at JD Logistics could actually change things day to day. More international investment, maybe faster, smoother deliveries when you order something from overseas. And domestically, all that investment in automation and optimizing riders, that can mean quicker local parcel deliveries, maybe even faster food delivery right to your door.
Right. It's worth thinking about how these high-level logistics plays, driven by finance and market competition, actually filter down. They actively reshape what we expect in terms of speed, reliability, and even cost for all the delivery services we increasingly rely on.